Today, we're going to be going through the reason why it does make sense sometimes to pay more for a business depending on this one key factor. This is something that I've only started really understanding more at a deeper level over the last few years. This is about capital light businesses versus capital heavy businesses. So I'm going to be going into an example between two different companies that I have looked at. One I've invested in, one is one that I passed on recently, but may still be an interesting opportunity for some of those that are willing to do a bit more research on this particular business. And I'm going to go straight into it and sort of explain to you the key differences that I find between them and ultimately why I ended up passing on the capital heavy business, even though it was growing and trading at only like 7 times PE ratio. So I'm going to get straight into it. I'm going to start off with the capital heavy business first. I personally like to call them takers as well, as sort of like a little way that I frame it, which is basically to say that throughout the business's life cycle, this business, in order to grow, always needs money. It's always short of capital. So it's always going to have to take, whether that is through dilution, whether that's through debt, or whether that's through any profit it makes. So we're going to get into this first example now, and then later we'll be talking about the sort of capital light business, also what I call a giver, and we'll go into the reason behind that. So the first example is a business I passed on recently, which is called Ashtead Technology Holdings. And this business, as you can see on the information here, it's trading at a P ratio of 9.5 times, and it's got a forward P of 7.5 times. When I first started looking at it, it was a bit cheap. I did pass on it sort of November time, and it was about 8.5 times earnings, about 6 times forward earnings, 6.9 ish. Anyway, the reason for myself sort of passing on this business, or the reason I didn't want to basically invest in this business, is because it is very capital intensive. So, what does this business in particular do as an example? So, they are basically a subsea rental equipment business. So basically, any offshore projects, whether that is oil and gas, whether that is renewable energy, this business will rent out its equipment to some of the largest players in the market based on sort of rough calculations because there is no one exact figure. I estimate that they're about 6% of the entire global market share, excluding China. And so, pretty big player in the market nonetheless, and it is a fragmented market as well. The business itself has grown phenomenally over the last few years, so I'll just give you a quick run of their numbers. So, as you'll be able to see here, 2019 they were only doing 48 million pounds basically, and from that period, now 6 years later, they're on track to do about 200 million in revenue this year. So that's more than a 4x in 6 years. So pretty impressive growth. The business has done very well for itself on that basis, and I think the so just if we have a look at the profitability, one thing you will notice though is over time is that even though their revenue has increased 4x, their profitability has increased just shy of that. And part of the reason behind that is, well, actually, as they've scaled, they have had some operational efficiency, but sort of part of the reason behind that is also because they've become more burdened with debt. And this is basically the crux of why I'm not as keen on this business, because ultimately, for them to make money, they need money. This is one of those type of business models. So what that means is they'll have debt from acquiring other smaller companies. Yes, it's at a cheaper valuation, but they still have to acquire them nonetheless. And ultimately, they then use that to grow their business. But what that always means is they're going to have to A, dilute shareholders, B, take on debt, C, reinvest their profits. So for this business in particular, because they're trading at quite a cheap multiple, they're not going to be diluting themselves. It wouldn't make sense to do that at current valuations. And frankly, even if they did dilute themselves, it's not as accretive for investors when you think about the fact that actually you're basically getting a smaller part of the pie every single time. And what that does mean is ultimately you're left with two methods, which is firstly, you're either going to, or you're going to do both, which this company has in this instance, is you're either going to take on debt, which is what this company has been doing. So if we look at their balance sheet, for example, you will see that their total liabilities is at 186 million, 188 million, with current assets of 82 million pounds. So, whilst their total assets are 326 million pounds, a lot of this is tied up in the likes of goodwill and intangible assets, which realistically are just the value of the businesses they've acquired. It's just the brand value of the businesses they've acquired. So yes, the businesses they've acquired are worth something, obviously, but it's not like something they can extract out of their business to pay their debt, unless they were trying to downsize their business, which they're not. They're trying to grow, right? So that's out of the question. So in reality, any sort of liquid assets they have, they're actually quite tight on them at the minute because they've got 188 million worth of debt that's coming due. Yes, that can be refinanced, and it probably will be as well. Then they've also got only 82 million in current assets. So they're basically left with 100 million that they need to sort of bridge somehow. And the issue here is that whilst they are profitable and they will continue to invest in sort of invest their profit going forwards. The issue here lies in the fact that, well, actually, because of that, they're not able to really return capital to shareholders anytime soon. So if you think about any sort of dividends, they're pretty much out of the question. I mean, they do have a dividend, but frankly, a 0.3% dividend yield, I don't think is attracting anyone. The only reason they do that is probably just so that certain indexes which have a mandate to invest in companies which have a dividend will be able to access this company as an investment. So it's more or less just to open up their liquidity opportunities rather than actually focusing on returning any meaningful capital to shareholders. And the same will go with buybacks. They won't be able to do any buybacks or anything of that nature to reward the shareholders. So what that does mean is that basically every single year they're hoping that this business is going to generate more and more in net income so that they can pay their debt off. So if you look at their net income, we know we have about, again, I'm being very rough with the numbers. I'm not going to do, this is very high level, intentional, because the aim isn't to study this one particular business, it's to understand the general characteristics that you'll see. So you'll see that this business has $30 million in £30 million in net income for the year. It will be higher by the end of this calendar year, so that's fine. But even if we just say £30 million as a rough number, again, we're not trying to be too specific. You will notice that actually, if they've got 100 million of debt outstanding left after, let's say, they use all their current assets to pay off all their debts, so net debt on that basis, then you will realize actually it will take them about 3 and a bit years to pay that debt off. Sorry, throat's going a bit. Here we go. And that is assuming that they don't take on any more debt. But this is the issue with this type of business model. And to be fair, it's if you are accounting for that and you are still comfortable with the risks, then that is completely fine. Because I'm not saying that I wouldn't ever invest in a business like this. It's just something to be aware of, which is that because of that, what that means is if they want to grow their business, their organic growth is very limited. So they're not actually growing because their products are receiving so much more demand. They're actually mainly growing through buying other businesses. So because of that, they're going to have very limited runway to acquire any other businesses beyond taking more debt. And as we know, debt sort of pressures the balance sheet. So if anything, if there was to be any slowdown, any sort of unexpected event to occur, this could very quickly put the business in a sticky situation where it is very difficult to get out of. So that's something that you have to be conscious of as well. So, I mean, if we just look on the balance sheet now, sorry, on the income statement, you will see that just based on the $180 million they have in debt, their interest costs alone currently are about, here we go, let's find it. So, interest expenses here are about 9 million. And that is, if you look at the net income, that currently is about a quarter to a third of their net income. So, that doesn't seem like a lot at the minute, but should the business continue to grow and continue this cycle, debt will more likely than not, particularly if they want to scale at this pace they have been doing so, this debt will more likely than not keep increasing, and so will the interest burden. So what that means is over time is that I wouldn't be surprised to see the interest cost to become a third of their net, to take up more than like a third of their net income over time, which doesn't sound like a lot still when you consider, oh yeah, the business is growing, but you have to take into account that these industries can be very cyclical. Rental equipment isn't as cyclical as oil and gas directly, but it still has major ties to it, and there can be major slowdowns as a result of that. And actually, you did see like 12 years back, you did actually see some of these players go bankrupt for that very reason. So that's definitely something to be taken into account as well when you factor in that the any sort of downturn is going to decrease their margin significantly because this is such a capital intensive, low margin business in general. I mean, if you look at their margins, it's about 12%. So it's not the end of the world, but you still have to take into account that any sort of downturn in demand is going to significantly drop off their net income potential for that year, and then you for those years as well. If it's a extended sort of duration of weakness. And what that does mean as well is the interest cost isn't going to vanish anytime soon. It's going to stay there on the balance sheet. So that's something you have to really take into account because that interest, whilst debt is a very good tool for growth, it's also a double-edged sword in that sense because the interest costs alone will not vanish overnight, nor will they get put on hold as the business goes into any sort of weakness. So that's definitely something that needs to be taken into account there from that perspective. And again, like I say, it's a very intensive business. Like, can you make money investing in these businesses completely? You can. It's very doable. I mean, if you look at sort of the track record of this business since it's gone public, like it has done generally quite well. If you would have invested right at the start, 2022, you would have, could have made multiples on your money. And there's nothing wrong with that as well. But it's just being cognizant of the risks, especially if some sort of downturn starts to occur and especially the valuation, you want to be very careful of what you're paying for these types of businesses, in my opinion. Now, there are sort of things to be said where if you can acquire this business at a very low multiple, if you can acquire sort of peers at a very low multiple and then dilute your stock because your stock might be trading at a PE of 20 and you dilute basically a PE of 20 and you're buying businesses at a PE of 8 to 10 times earnings, you are making money on that spread. But it is something to be conscious of that these types of businesses do carry extra risk and they aren't necessarily, I wouldn't pay up as much as I would for the second example, which is what I call more of a giver. And what I mean by that is rather than you being diluted or the business taking on more debt, what's actually happening is oftentimes these businesses are so capital light and capital efficient when you can find them that actually they pay you to grow. And what I mean by that is that oftentimes the amount of money they have it no longer becomes, to an extent, no longer becomes the limiting factor. And as a result, oftentimes, as the business is actually growing and scaling, you're actually being rewarded for that and getting paid. So whether that's through dividends, buybacks, or just simply the balance sheet becoming cleaner and cleaner as it gets delevered. So this is a really good example of one business I personally own. And essentially, Kaspi is, most of you won't have heard of this business because it is based in Kazakhstan, but it's still a very good example nonetheless. They are essentially like the WeChat of Kazakhstan. If that doesn't mean anything to you, WeChat is like a 1 billion user platform in China, but in essence, it's the internet of everything. may as well be for Kazakhstan. This is what this business is, and what that means is they have a bunch of services within this like super ecosystem app they have. So that includes the likes of their own version of Amazon. They have their own digital bank in there. They have their own loads of different services, including government services, tax related services that you can use. They do payments on there. So think of it as like Amazon, PayPal, sort of a government services arm as well. They even do online grocery shopping. There's so much that you can do on this platform. And it's a very capital efficient business model, has historically been. Now, there are some nuances because obviously they have a banking segment. So the banking segment isn't obviously going to be as capital light, of course, but they do then take on deposits, so it sort of neutralizes itself there. But I'm going to exclude the banking deposit for a sec, just to give you a bit of an idea of this type of business. So historically, this business has also done a phenomenal job growing. It is compounding significantly over the years. And one of the things I really love about this business is it is insanely capital light. So just to give you a bit of context, in Kazakhstan at the time, Kaspi, looking back 5, 10 years ago, there was very limited options in terms of receiving any funding to grow and scale the business. So Kaspi has always had to grow in a very capital efficient manner. They've got this sort of ecosystem of we have to make it profitable in the first year, otherwise we just kill it kind of thing. That's sort of the mentality they go into it with. And that has served them very well as they've sort of ventured into new areas and scaled as a result of that. So if we look at some of the statistics around their return on capital, you will see that here we go, that their average return on equity has been around 59%, which is just almost unheard of. Again, return on invested capital 64%. So very strong return on capital metrics. And all that basically means is historically any sort of dollar that Kaspi has put into their business, within year one, they've gotten back 64 cents in profit. And they've just then continued to reinvest it at that rate, which is just phenomenal. But part of the reason behind this sort of growth has been that their ecosystem flywheel effect has just really taken off. And what that really means is that because some people use their services for payments, once they use it for payments, then they'll also use it for their marketplace. And because they're also using it for their marketplace, they're also going to use it for their government services as well. And these sort of like the more you use the platform, the more beneficial it becomes because you benefit from all these features because you've got your details saved there, you bank from there. It's very easy to pay for something on there. All your transaction history is on there, so it's very convenient to do your taxes on there. It's basically a one-stop shop for the internet. It's a very sort of efficient model, and then obviously the more you use it, the more other people are more likely to use it because then it attracts new merchants to the platform because if there's a lot of users, merchants will naturally want to join. Because it's so efficient and so easy to pay, it's very easy to convince other people in the country to use the platform to basically transfer money to each other, just like the way, if you were to send your friend £5 or whatever amount is, $5, etc., right? It's very easily just you're able to transfer money literally in seconds. I know companies say seconds, but here it's literally seconds. You put someone's phone number in, as long as they've got Kaspi, you put their phone number in, how much you want to send them, and boom, it's gone. It's verified and it's sent. And it's literally that quick. Sometimes it's even quicker than that. So this is like really, really top tier technology, world class even. And it's, in Kazakhstan, where historically the infrastructure hasn't been as good when it comes to internet infrastructure. Now, I'd say Kazakhstan actually is further ahead compared to other countries, but that's going off into a side tangent because that's around sort of the developments around Kaspi and their competitors. But my main point here is that this business has always been extremely capital efficient. And it's very disciplined in its growth approach. It's never overextended itself, never done any massive sort of loss-leading campaign to try and grab as much market share, only to then lose it back when it realizes how unprofitable it is. It's always been very disciplined in its approach, and it's always used the ecosystem very wisely to its benefit. It's always added on services that makes the entire ecosystem valuable, and because as well the the quality of the service on there is so great and so vastly superior to competitors. They have basically never really needed to spend money on advertising because their word of mouth was so strong. And what that's led to is basically very little advertising costs. Essentially, they're just paying to build and maintain the app. And you get customers coming in because it's so much better than any of the alternatives out there. For context, for those of you who don't know, I think Kaspi has 14 million users. In Kazakhstan, I think there's only about 18. I think there's only about 20 million adults in Kazakhstan itself. So it basically has 2/3 of the entire market share in the country, which is just ridiculous. Um, it's hard to pinpoint an exact number because they've stopped disclosing it, because essentially, why put a spotlight on their own monopoly if they don't need to? That's sort of, I think, the thinking behind that. But the thing with this business is because it's been so capital light, it's never really needed any significant capital to grow. So what's that led to? It's led to a very healthy balance sheet, and it has led to very significant dividends as well. So just sort of give you an idea of the balance sheet. Now you have to take into account that because of their banking operation, it is somewhat skewed. They obviously have deposits on there, which basically skew the balance sheet. But I'll just try and sort of pull up here. So you will see that they've got it's 8 trillion in liabilities, but again, that's in Kazakh tenge. So I think it's what the conversion rate nowadays is like $1 to 600 Kazakh tenge. I want to say 600 Kazakh tenge off the top of my head. But 8 trillion Kazakh tenge, and then you will see that their total current assets alone are basically matched that at 7.8 trillion Kazakh tenge. So basically, the current assets alone are enough to pay off the debts. And you also have to take into account that a very significant portion of this, in fact, the vast majority of this debt, is simply just their depositors that are on there, which is obviously a very efficient way of using capital, because they're going to pay their depositors a much lower interest rate than if they had to take out a loan from a different bank or someone else other than themselves. And what you will also see on here as well, if I just go into the dividends, and I'm going to get into why they've cut their dividend in a second, but you will see that they have paid out significant dividends every year pretty much for the last few years. And it's been an increasing dividend as well, particularly as the business has continued to scale. I think before they cut the dividend, it was about a 5 to 10% yield. Let me have a quick look for the exact figures. We'll just calculate it now. Okay, so yeah, so as you can see, in 2024, they paid out just shy of $8. Let's just call it $7 in dividends. The stock is currently trading at $73. So that again gives you an idea. It's about a 10% plus yield there, right? And that just shows you sort of the significant amounts of capital that this business is able to return to you as an investor. And again, it's not because the dividends are so much higher here because it's a much cheaper valuation. That's not even the case. These two businesses are trading at actually very similar valuations, a P ratio of 9.5, seven times earnings. Now, I'm not saying necessarily one is better over the other, because this business obviously has risk. It's based in Kazakhstan, etc., right? And nor is it any sort of advice like that. So my thinking here is that, well, this business, in terms of why I prefer capital light businesses, is the fact that you're being paid to grow. So literally, as the business scales over time, you will continue to get rewarded more. The dividends over time will increase. Whether that's dividends, they've considered doing buybacks. So it really depends on management there as well. And also, if it doesn't go there, it's always going to go to the balance sheet, which is just going to de-risk the company, because it's not going to be as high risk. And as a result of that, also, they're not going to have any looming interest costs that are nowhere near as high. So what that means is, if the business was to go, if the business was to take a turn for the worse, it might be in a period of weakness, they're not going to struggle with the same sort of interest costs that they're forced to pay. And they will have cash runway to sort of let them continue growing. In terms of why this, to protect them, sorry. In terms of why this particular business has cut their dividend, they've actually made a significant acquisition recently. So rather than diluting their stock, especially at such cheap valuations, or taking on significant amounts of debt. They've opted to take on some debt and then also fund the rest through stopping their dividend, which they're then going to continue. They've always said anyway the dividend was like 50% of the excess cash that they're not going to use. And that's sort of the reason behind this business doing that and stopping its dividend. It's actually going to re-continue it, I believe, in first half 2026 or second half 2026, based on sort of management calls. Again, that's sort of the reason why I prefer. And also, one thing that I've generally noticed, it's not a fixed rule, but one thing I have generally noticed is that capital intensive businesses are usually lower margin in nature, and capital light businesses, for obvious reasons, because they typically don't have to invest in marketing and all these, maybe perhaps not marketing, but they don't have to invest in these very significant expenses such as interest costs. Oftentimes, because capital is not a limiting factor, it also means that marketing is also not necessarily a limiting factor to its growth. They are able to have much higher margins as a result as well. And that's typically allow them to be more well insulated as well if there's to be a recession or anything of that nature. And they're sort of the reasons why I prefer capital light businesses, because ultimately you over time get paid to hold this business. Whereas the second business, you just get paid based on how much the business can grow. But you very oftentimes you can take on more risk over time as the balance sheet gets more debt loaded. Whilst obviously those capital heavy businesses will oftentimes try to pay off the balance sheet as best they can. There's only so much they can do that with their profits when they're growing. So that's something to take into account as well. And ultimately, it's very hard to determine, well, what's the difference in these two businesses worth. It is ultimately comes down to a judgment call. But one thing I do like to think about, well, is how much would I pay for a business that I know is going to grow 5-10% a year, but also it's going to give me 5-10% a year in dividends or in buybacks, or just simply paying off the debt on the balance sheet, right? Versus one that's going to have to keep taking away 5-10% a year from me to then grow maybe 10% or 15%, right? So that's another way I like to frame that in my head when I'm sort of thinking about it. I know other investors I have heard what they'll do is basically if they know that the business is able to grow 10% a year whilst paying you a 5% dividend, they'll class that as like 15% return in their head sort of thing. So there's different ways to sort of calculate it. There is no sort of fixed rule, and that's kind of what makes it hard to distinguish between these businesses and how do you exactly value it, because there's no exact science behind it. But it's just the main thing is just being aware of it. And again, it's not to say that I won't invest in a capital heavy business. It just means that I would be looking for stricter criteria when I'm investing in those types of businesses, whether that's just a better price earnings ratio, whether that's I still want it to meet certain requirements, perhaps not a cyclical industry. What's the balance sheet looking like? I want to know the management better, etc. There's loads of factors that I would need to look into as well. But they are generally sort of the reasons behind it. And I hope that sort of answered your question between why I would prefer capital light versus capital heavy business. If you've got any questions, let me know in the comments and I will be answering them. So thank you.